Let's move on to the November 15th entry, where Portnoy Drumsticks is selling 80 pairs of jazz sticks to Whiplash Sound Studios. Let's start by recording the revenue portion of the sale in our journal. So on November 15th, we are selling to Whiplash Sound Studios, and we are doing so on account. So let's debit AR Whiplash, asset account increasing, and let's credit sales revenue. And what happened here is we sold inventory on accounts, and in this transaction we're going to use the same terms that we've been doing all the way through, which is 310.60. For how much? Well, let's go back and figure out what we're selling. We are selling them 80 pairs of jazz sticks, and we sell our jazz sticks at $8 a pair. And in this case, they are getting terms of 310 net 60. So when we record this in the journal, we can start by going to our information, taking the price that we are selling each one of these units for, multiplying it by the number of pairs that we are selling, which is 80, and then multiplying that by the portion we expect to collect. Since we're giving them 310 and we're assuming they're going to get the discount, we're only going to see 97% of that, which is $620.80 we think we're eventually going to receive from Whiplash Sound Studios. As the entry to record the revenue portion, let's put in the entry to record the expense portion. So we have a debit to cost of goods sold, and our debit to cost of goods sold is going to be over a credit to merchandise inventory. And for description, the second entry we records the expense. It in fact records the cost of goods sold on the sale. For how much? Well, we don't know that yet. We're going to have to figure that out by adjusting our perpetual inventory record. So let's go to our perpetual inventory record, and we're going to figure out exactly where these 80 pairs of jazz sticks that we're selling on November 15th are coming from. So we're selling jazz sticks. Let's go down to the jazz stick table. Date is November 15th. We have cost of goods sold over here, and like I said, in our transaction we are selling 80 pairs in total. Well, we use LIFO, which means we always sell our oldest inventory first, and our oldest inventory is the 70 units we have remaining from beginning inventory. Well, we got to get to 80, so let's assume that we're going to sell all 70 of those. Now, after I fix these decimals, we've accounted for 70 of the 80 units that we are selling. So how many units have to come out of our next layer of inventory? 10. And those 10 are going to come from our second layer, which had a unit cost of $325. So to figure out the total cost of that, that's $32.50 coming from that particular layer. What do we have left? We had $73 units, but we sold them all. They're all gone. We had 50 $3.25 units, and we're selling 10 of them, which means we have how many left? We had 50, we got rid of 10, means we have 40 units left in inventory, and they are all 325s because we sold all of our $3 units, which means that the total cost of our inventory is going to be $130. Let's underline that to say that we're done. So how much is the cost of goods sold we're going to record in our transaction? Well, let's hit equals and go back to our perpetual inventory record. We sold $210 worth of inventory that we had left from our beginning inventory, and we also sold $32.50 worth of inventory from our November 5th purchase. We add those two together and we come up with a total of $242.50 is our cost of goods sold. And again, you can always go and check to make sure that your numbers make sense beforehand. If we add these two layers together, that comes out to $372.50. We're down to 130. What's the difference between 372.50 and 130? $242.50. So we finished the November 15th transaction. We're on to the November 16th transaction. We received payment from Blastbeat for the November 12th sale. Every time that you receive payment, you got to look at first things first and say, are they paying within the discount period? We sold this on November 12th, it's right there. And when we sold on the 12th, we said pay in 10 days, you get 3% off. This is only happening on the 16th, which is 4 days later. So they are in fact paying within the discount period. So what are we going to do here? Perpetual inventory record does not need to be adjusted. When you're collecting payment, doesn't change your inventory flow. We took that inventory out at the time that we sold it. Nothing's changing here except for the cash is coming in. They're no longer going to owe us money, so we don't need to mess around with our perpetual inventory records. We can go right to the journal. In our journal, on this November 16th, we are receiving payment. Well, we're receiving payment, which means our cash has to go up, and since cash is an asset and it goes up on the debit side, we're going to debit cash, and we are going to credit the account receivable that we're taking off of the books. And again, just double check with our information. We are receiving payment from Blastbeat from November 12th. So if we go back up to our journal, on the 12th, our receivable from Blastbeat was for $582, and it is coming off of the books. So let's take that off of the books and assume that we're getting that much cash. So right here we're getting $582 in cash, and AR Blastbeat asset account going down is going to decrease by $582, taking it off our books. And what happened here is we collected from Blastbeat within the discount period. Next journal entry we have is on November 17th, where we purchased an additional 100 pairs of 7B jazz sticks from Hickory Sticks at a price of $3.30 a pair. So if we go back to our perpetual inventory record, we can throw this into that record because we're purchasing, which means it's changing the amount of inventory that we have, which means we need to change our perpetual inventory record because that changes every time our inventory balance changes. We're buying 7B jazz sticks, 100 pairs of them at $3.30 a pair, so we need to put that into our 7B jazz stick section over here. And this is happening on November 17th. What are we buying? One more time. Buying 100 pairs of sticks at $3.30 a pair. So our quantity of our purchase is 100. Our unit cost is $3.30, which means that our total cost was $330. We're still using the FIFO method, which means we got to layer our inventory. So let's bring down what we had, and let's copy over what we just purchased. We had, and we'll fix our decimals first. We had 40 units that cost $325 a piece for a total cost of $130. We have 100 units now at $330 a piece for a total cost of $330, and we can underline this to show that we are done. So we're going to have to record this purchase. Well, let's make that happen. This is happening on November 17th. We are buying inventory, so let's debit our merchandise inventory account. And even though we're not getting any terms, we are paying on account here to our one and only vendor, which is Hickory, that we have outsourced manufacturing to. For how much? Back to our perpetual records, it was for a total of $330. And here we purchased inventory on account, and there were no terms. Next transaction happening on November 18th. It's going to look pretty similar. We're buying an additional 40 pairs of 2A rock sticks, our other type of stick, from the same vendor, Hickory Sticks, and we're doing so at a price of $4.40 per pair. So if we go to our perpetual record, we got to go to our rock stick table because that's what we're buying. This is happening on November 18th. And we can go and we can check one more time to see what our quantity and cost was. It's 40 pairs of rock sticks at $4.40 per pair. So 40 pairs at $4.40 per pair means that we are paying in total $176 for this purchase. Still the FIFO method, which means we still have to layer our inventory. We have to bring down what we had. We had 20 pairs of $4 sticks for a total of 80. We had 20 pairs of $4.20 sticks for a total of 84. We're going to bring those down, and I'll fix that in a second. And then we purchased 40 pairs of $4.40 sticks for a total of 176. Fix our decimals again, however you want to. There we go. And now we've got 3 layers of inventory for our rock sticks. So there will line underneath this, and we need to record the purchase in our journal still. So on November 18th, we're going to make the same exact entry that we had above, because we only have one supplier, just for a different amount. So it's still a debit to merchandise inventory and a credit to AP Hickory, where we purchased inventory on account with no terms. So what is the amount we're going to record? It's whatever we put in our perpetual inventory record. In this case, it's going to be that $176 total cost of our purchase. Next up, we have November 19th, where we sold 50 pairs of 2A rock sticks to Paradiddle Percussion with the same terms that we give all of our customers, $310 net 60. So let's go to our perpetual inventory record and figure out the sale. Actually, let's go to the journal first and record the sales portion of it. And we'll go and adjust that for the COGS portion. So on 11/19, we are going to have a debit to our subsidiary receivable account for Paradiddle Percussion, called AR Paradiddle, and a credit to sales revenue for the amount that we are expecting to receive. Well, I'm going to go ahead equals over here. I'm going to go back to the information. And in AR Paradiddle, what happened here? We sold 50 pairs of 2A rock sticks. We traditionally sell those rock sticks at $10 a piece. So if we're selling 50 of them at full price, it would be $500, 10 times 50. But that's not what we're expecting to get, because we think they're going to get 3% off, just as we assume all of our customers are going to get 3% off by paying on time. So we're only going to see 97% of that. So that 10 times the number of sticks that we are selling times the 97% we expect to collect is $485. And down here we sold inventory on account with terms of $310 net 60. Now we got to record our COGS entry. So let's go to our perpetual inventory record and figure out how this sale of 50 pairs of 2A rock sticks to Paradiddle Percussion is going to affect our records. Well, we're selling 50 pairs, and there are rock sticks, so we got to go to the rock stick table. How are we going to get about selling these 50 pairs on November 19th? Well, now we got some work to do. We are using FIFO. We assume the oldest units we have in inventory are the first to go. What are the oldest rock sticks that Portnoy has in inventory? They're the $24 pairs that are still remaining from our beginning inventory. So let's sell all of those. We got to get to 50 in total, which means we got to keep chipping away at layers until we get up to 50. Well, our next oldest layer are the 20 pairs of $4.20 sticks we have left from the November 6th purchase, and that's still not going to get us to 50, so we got to assume that we're selling all of those. So now we've accounted for 40 pairs in total while we're selling 50, so how many sticks have to come out of our last layer? 10. So we assume that the last 10 sticks that we are selling are at a unit cost of $4.40, which means that's going to contribute $44 towards our cost of goods sold. So again, let's go and fix this really fast. And what do we have left? Well, we had $24 pairs of sticks. We had $24.20 pairs of sticks, but we sold all of that right here. We had $4.40 pairs of sticks, but we sold 10 of them, which means there are 30 left. The unit cost is still $4.40, which means that our total cost is $132. So let's go, put a bottom border in there. That's what we have left. Now we go to our journal and record this cost sold for this particular transaction. And we need to decrease our merchandise inventory by whatever that same amount is in our entry when we recorded COGS on sale. So how much is it going to be for? Well, back into our records, it tells us that we sold $80 worth of $4 sticks. We sold $84 worth of $4.20 sticks. And we sold $44 worth of $4.40 sticks. So if I add those three numbers together, which I did up here in our little formula bar, and I hit enter, that's $208 worth of inventory. That was the cost basis of the inventory that we sold to Paradiddle. So that's what we're going to put on our books for, and we're going to decrease our merchandise inventory by the same amount.